Don't be fooled by ultra-high income ETFs. I wouldn't think I would have to warn people that if you're being offered a yield of 100% or more on a fund, the risk has to be extremely high and there is probably a good chance for loss. However, with that said, this year alone, $6.4 billion of new money has been placed into these high-risk funds that I assume are unsuspecting buyers who don't really understand how these funds work. Regulatory filings show that at least 95% of these ETFs are held by individual investors or small financial advisors. The way they generate this high income is by trading options contracts on a single stock. It is misleading how they come up with these ultra-high yields of 100% plus as they take the ETF's payout from option trading in the most recent month, then multiply it by 12, and then divide it by the fund net asset value. As an example, we can go back to November 2022 when a fund called the Yield Max TSLA Option Income Strategy ETF, symbol TSLY, sold options on Tesla stock and promoted the yield was 62.8%. Gosh, how could you lose? The fund has now dropped down to under $9 a share, roughly an 80% drop in the fund. This is somewhat surprising to most since during that same time frame, Tesla stock is up around 70%. Sometimes people think just because there's an income or nice yield that the fund is safer. But investors should remember that in most cases, the higher the yield, the higher the risk. I'm Brett Wilsey with Wilsey Asset Management. If you like these videos, be sure to get a like or comment and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.